Imagine a headline that, well, at first glance feels almost contradictory, right? Like
Yeah.
something ripped from I don't know, a speculative financial thriller.
Hmm.
You've got the venerable halls of Harvard University, centuries of tradition, academic rigor, very conservative financial stewardship.
Absolutely. The epitome of establishment thinking in many ways.
Exactly. And suddenly they're making this major multi-million-dollar play in well, let's face it, the often volatile, definitely innovative world of cryptocurrency.
It does sound fantastical, doesn't it?
It really does. Yet here we are. This is very, very real. And it signifies something profound, I think.
Indeed. It's the kind of news that causes a collective double-take across the financial world.
Right.
Harvard,
Right.
an institution with the largest university endowment globally, known for its meticulously managed, long-term, traditionally focused portfolio, now holding significant exposure to Bitcoin.
Through a regulated investment vehicle, which is key.
Which is absolutely key. It's not just a remarkable development. It fundamentally challenges many long-held assumptions about institutional asset allocation and, the future role of digital assets.
And that's our exact starting point for today's deep dive. When you hear that Harvard has invested this, well, staggering amount into a spot Bitcoin ETF, the immediate internal monologue for many, whether you're deep in crypto or maybe steeped in traditional finance, is likely, wait, how? And why now?
Yeah, it's a jolt.
It's a genuine jolt to the system, right? Forcing reevaluation of preconceptions. So what does this all truly mean? Not just for Harvard, but, for the broader financial ecosystem. Let's unpack this. And as we do, if you find this kind of deep dive valuable, please maybe take a moment to hit that subscribe button, perhaps leave a comment, or share this deep dive with others.
It really helps.
It genuinely does. Your engagement truly helps us reach more curious minds and keep delivering these in-depth analyses.
And our mission today is to move far beyond just that initial headline shock. We're going to systematically explore let's say, the intricate nuances of this specific investment. Understand its context within Harvard's colossal multi-billion-dollar portfolio, and then really dig into what this signals for the accelerating mainstream adoption of digital assets, both within the U.S. and, frankly, globally.
Right, because it's not just about Harvard in isolation.
Not at all. It's about recognizing that this isn't an isolated event, but rather a significant data point in a much larger ongoing narrative, a trend, really.
And to provide you, the listener, with the clearest, most accurate picture, we're drawing from some incredibly solid, verifiable sources here. We've meticulously reviewed official financial filings with the U.S. Securities and Exchange Commission, the SEC, which, are the gold standard for transparency and public disclosure in the financial world.
The official record. Yeah.
Exactly. We're also pulling from detailed market reports, analytical insights from top financial news outlets, and expert commentary that provides, the granular data and the necessary contextual frameworks to truly understand this move.
The overarching goal here is simple, but I think profound: to extract the most important nuggets of knowledge and actionable insights from all this complex material.
Right.
We aim to help you, our listener, understand the true multifaceted significance of this move, not just for Harvard and its future financial strategy, but really for the entire global financial landscape.
Yeah.
It's about seeing how various threads connect, how emerging patterns reveal themselves, and how the implications of decisions like this ripple outwards across markets and investment philosophies. We want to empower you with a comprehensive understanding that goes way beyond the surface level news.
All right, let's dive right into the core revelation then. The thing that ignited this entire conversation and has sent ripples across both Wall Street and the crypto world.
Let's do it.
The numbers first and foremost, because, well, they speak volumes. Our sources, specifically Harvard's official financial disclosures, they reveal that Harvard University's investment portfolio held a staggering $117 million worth of shares in BlackRock's spot Bitcoin ETF.
Yeah, the ticker symbol is IBT.
IBS, right. And this was at the close of 2025's second quarter, so pretty recent data.
It's absolutely crucial to emphasize the precision of that figure, $117 million, and maybe even more importantly, the specific investment vehicle used.
Right, not buying Bitcoin directly.
Exactly. We're talking about a precise sum, $117 million. And the key distinction here, as you said, is this is not a direct purchase of Bitcoin itself, which would involve, managing private keys, navigating complex custodial solutions.
And that tricky stuff.
Dealing with the less regulated aspects of the crypto market. Instead, it's an investment through BlackRock's iShares Bitcoin ETF. This distinction is vital because it means Harvard gained exposure to Bitcoin's price movements while leveraging the existing, robust, and, frankly, regulated financial infrastructure that they were already deeply familiar with.
It just fits into their existing workflow, basically.
It simplifies the operational complexities immensely, reduces friction.
And the fact that this information became public via an official filing with the SEC on a Friday, as our sources highlight, that adds a significant layer of credibility and transparency, doesn't it?
Oh, absolutely. It wasn't a rumor. It wasn't a leak. It wasn't some anonymous source.
No sources say.
Exactly. It was a formal, accountable disclosure. These were typically 13F filings.
Right.
Which are mandatory quarterly disclosures by institutional investment managers with, I think it's at least $100 million in assets under management. They provide a public snapshot of their equity holdings.
So it's required by law.
Precisely. When Harvard Management Co. Inc., the entity that manages the endowment, makes such a filing, it's not just a procedural step. It's a definitive, verifiable statement of their investment strategy at that point in time. This official disclosure immediately validates the investment in a way that no private report or market rumor ever could. It signifies a clear, deliberate allocation of capital that they are legally obliged to report. And that transparency, it offers immense confidence to other potential institutional investors who are watching very, very closely.
Okay, so to really wrap our heads around the magnitude of this $117 million investment, we need to put it in context, right? Within Harvard's broader, truly immense portfolio.
It's huge.
This wasn't just a speculative side bet or some small experimental allocation. Our research indicates that this Bitcoin ETF holding ranked as Harvard's 5th largest investment at the end of the second quarter.
5th largest. Just let that sink in for a moment.
Because it's kind of stunning.
It really is a powerful statement. When we say 5th largest, we're talking about an endowment that manages, what is it now? Over $53 billion.
53.2, I think, as of June 30, 2024.
Right. So for a relatively nascent asset class, I mean, even packaged nicely in an ETF, for it to command such a prominent position in their top holdings, it speaks volumes about their conviction, maybe their long-term conviction.
It's definitely not a rounding error.
No, it's clearly a strategic position.
And to give you an even more concrete and frankly pretty surprising comparison that really illustrates this shift, consider this. The investment in BlackRock's Bitcoin ETF actually placed just ahead of Harvard's investment in Google's parent company, Alphabet.
Wow. Okay.
Our sources show Harvard held nearly $114 million worth of Alphabet stock during that same fiscal period.
So Alphabet was number 6, effectively.
Effectively, yeah. So you have this new frontier of digital assets sitting just above one of the quintessential traditional tech giants in terms of portfolio allocation. That's a clear signal of evolving investment priorities, wouldn't you say?
That juxtaposition truly highlights the strategic shift underway. I mean, Alphabet, a company that has fundamentally reshaped the digital economy, it's a bedrock of so many institutional portfolios.
Oh, absolutely.
It's still a traditional equity holding. Bitcoin, even through an ETF, represents a fundamentally different, decentralized asset class.
Right.
For Harvard to prioritize exposure to a Bitcoin ETF over, say, an additional allocation to a tech titan like Alphabet, especially given Alphabet's proven track record and massive scale, it's an undeniable declaration of confidence.
It suggests they see something unique there.
It suggests they see unique value, perhaps unique diversification benefits, maybe long-term potential in Bitcoin that rivals even the most established high-growth companies. It's your reevaluation of what constitutes a core holding, potentially.
And just to put the entire scale into perspective, Harvard's largest investment, just to give you the top of their list, was over $310 million in Microsoft shares.
Okay, so still heavily into big tech.
Oh, yeah. So while the Bitcoin ETF sits at 5th, it's in a very esteemed company, right? Firmly within their top-tier holdings, alongside some of the world's most dominant and, let's say, traditional blue-chip technology companies.
So it's not a minor foray. It's a significant commitment, relatively speaking.
Yeah.
And all of this massive sum, is meticulously managed by Harvard Management Co. Inc. That's the highly sophisticated entity specifically responsible for overseeing the university's colossal $53.2 billion endowment fund, as you mentioned, as of June 30, 2024.
And just to reiterate, that figure makes Harvard's endowment the largest among U.S. universities, right? Bigger than Yale, Stanford, Princeton.
Significantly surpasses them, yeah, it's the behemoth. And the financial decisions made by Harvard Management Co. Inc. aren't just impactful because of their sheer scale. They're also watched incredibly closely by institutional investors, pension funds, sovereign wealth funds, really everyone worldwide. Their moves often serve as a kind of tacit validation for others who might be considering similar allocations.
They set a tone. So, when an institution like Harvard, which, as we said, has long been synonymous with conservatism, academic rigor, financial prudence, makes such a substantial and publicly disclosed move into the crypto space, what's the immediate aha moment for the broader market?
What's the takeaway?
For me, it unequivocally signals a significant vote of confidence in Bitcoin as a legitimate investable asset class. It's propelling it further, much further into the financial mainstream, arguably, maybe, beyond a point of no return for institutional adoption.
I think that's absolutely right. The symbolic weight here is tremendous. Harvard's endowment, it's often seen as a bellwether, right? A leading indicator for broader institutional investment trends.
People follow their lead.
They do. Their decisions are never impulsive. They are the culmination of deep analysis, extensive due diligence, strategic long-term planning, often involving years of research and, I imagine, intense internal debate. This investment isn't just about the financial exposure they gain. It's an implicit endorsement. It's a public stamp of approval that tells the world, look, Bitcoin, especially when packaged in a regulated product like an ETF, is now a serious contender for even the most conservative institutional portfolios.
It kind of gives others permission, almost.
It systematically dismantles a significant layer of skepticism that many traditional investors and their very cautious investment committees probably still harbored about the asset class's viability and safety. It provides, as you say, a powerful cover for others who were perhaps waiting for a leader, a respected name, to step forward.
And this leads us perfectly into understanding the very vehicle Harvard used, the spot Bitcoin ETF. For our listeners who might be familiar with traditional ETFs, but maybe less so with the nuances of spot Bitcoin one, can you demystify what it actually is and why it's been such a game changer for institutional access?
Of course. Yeah, let's break that down. At its core, a spot Bitcoin ETF is basically an investment fund that directly holds actual Bitcoin.
The real stuff.
The real stuff. This structure allows investors to gain exposure to Bitcoin's real-time price movements without actually having to go through the, frankly, complex process of buying, holding, and securing the underlying cryptocurrency themselves.
Okay.
Think of it conceptually like a gold ETF, which is something people are probably more familiar with. You invest in shares of a fund, and that fund holds physical gold bars in a secure vault somewhere.
Right.
In this case, the fund holds actual Bitcoin, typically with a reputable, qualified custodian. The crucial distinction from, say, a futures Bitcoin ETF.
Which came earlier.
Exactly. Those invest in Bitcoin futures contracts, which are derivatives. The spot ETF provides direct exposure to the current market price, the spot price of Bitcoin, reflecting immediate supply and demand dynamics. And that's generally what institutions prefer.
Direct exposure without the direct headache.
That's a good way to put it.
And for large institutions like Harvard, with their massive scale and, I imagine, very strict operational protocols, what are the specific tangible advantages of using an ETF like this rather than just going out and buying Bitcoin directly? It sounds like it streamlines things, but what are the really deep-seated benefits for them?
It addresses numerous, previously almost insurmountable operational and regulatory hurdles for institutions. Huge benefits.
Okay.
Firstly, there's immense ease of access. They can buy and sell shares of the ETF through their existing traditional brokerage accounts, using their existing financial systems, just like they would trade any stock or bond.
Familiar territory.
Totally familiar. It eliminates the need for specialized crypto accounts, unfamiliar trading platforms, new counterparty risks in some ways. Secondly, liquidity is a major factor.
Right, getting in and out easily.
Exactly. ETFs are traded on major stock exchanges throughout the trading day, making them highly liquid assets. That's critical for large funds that might need to enter or exit significant positions efficiently without moving the market too much. Thirdly, and perhaps most crucially for institutions like Harvard, there's comprehensive regulatory oversight. These funds are registered with and regulated by the SEC.
That's the big one.
That's the big one. It provides a layer of security, compliance standards, and investor protection that direct, often unregulated crypto ownership just doesn't offer. It brings Bitcoin into a familiar and, importantly, trusted regulatory perimeter for them.
Right.
And finally, it completely bypasses the immense complexities of custodial challenges of direct crypto ownership, managing private keys securely,
Yeah.
setting up highly secure multi-signature digital wallets, dealing with hot and cold storage solutions, navigating various crypto exchanges, ensuring internal audit trails that satisfy their auditors. These are significant operational and security challenges.
Things they probably don't want to build internal expertise in overnight.
Exactly. Many large traditional institutions are simply not equipped or, frankly, not willing to handle that directly. An ETF streamlines all of that by offloading these responsibilities to the fund manager, like BlackRock, and their licensed custodians. It removes all that picks and shovels work for the institutional investor.
Makes perfect sense. And the pivotal moment, the thing that truly opened the floodgates for this kind of institutional capital, making Harvard's move even possible in its current form, that was the SEC's long-awaited approval of these spot Bitcoin ETFs, right? After years of saying no.
Absolutely. The SEC's approval for the listing and trading of BlackRock's Bitcoin ETF and 10 other similar funds back in January 2024, that was nothing short of monumental. Game-changing.
It felt like a long time coming.
Oh, it was. For over a decade, the crypto industry, along with a growing number of institutional players, had been pushing for a spot Bitcoin ETF. The SEC had consistently rejected applications, citing concerns about potential market manipulation, investor protection standards, and the sort of nascent nature of crypto custody arrangements.
Right, the Wild West argument.
Pretty much. So its approval, which came after years of legal battles, notably Grayscale's lawsuit victory, and persistent applications from major players like BlackRock, it signaled a major fundamental shift in regulatory posture.
Okay.
It essentially acknowledged that the market had matured sufficiently and that the proposed ETF structures with their surveillance sharing agreements and established custodians offered adequate protections for investors.
And why was this spot ETF approval so much more crucial than, say, the earlier approvals of Bitcoin futures ETFs? Was it just about convenience, or was there something more fundamental that really unlocked institutional money?
It was far more fundamental than just convenience. Futures ETFs, as we touched on, are based on contracts betting on Bitcoin's future price. They don't directly hold the asset.
Right, different beast.
Different beast entirely. They carry different risk profiles, tracking errors, and often incur costs related to rolling contracts, known as contango costs. The spot ETF approval, however, this effectively legitimized Bitcoin as an underlying asset in the eyes of a vast swath of traditional finance players.
The actual Bitcoin.
The actual Bitcoin. Players who had previously been wary due to the inherent regulatory uncertainties surrounding direct crypto ownership. It provided a regulated, accessible, and direct investment product that bridged the perceived gap between the, sometimes seemingly chaotic digital asset world and the established, highly structured financial system.
Gotcha.
Without that SEC green light, without that clear regulatory pathway, institutions like Harvard would likely not have been able to consider such a substantial allocation, or at least not with the same level of confidence and without facing significant internal hurdles and external scrutiny from regulators, auditors, and trustees.
It was the missing piece.
It signaled that Bitcoin, when packaged correctly within a regulated wrapper and with robust institutional-grade custodial solutions, could finally meet the stringent requirements of traditional finance and its fiduciaries. It really was a key that unlocked the institutional gates.
And speaking of BlackRock's fund, IBIT, it sounds like it has been nothing short of a phenomenal success story since its launch back in January 24. The speed of its asset accumulation has been truly remarkable.
It has been extraordinary, almost unprecedented, really. BlackRock's spot Bitcoin ETF, IBIT, is genuinely described by many market analysts as one of the most successfully launched exchange-traded funds in history. Not just crypto ETFs, but ETFs across any asset class.
Wow.
The numbers truly speak for themselves. As we noted, the fund currently boasts approximately $84 billion in assets under management, or AUM, is based on the end of Q2 2025 filings.
$84 billion.
And BlackRock's own more recent data, cited in reports as of a recent Thursday, showed that figure had already surged past $86 billion in net assets.
Incredible growth.
It demonstrates not just rapid initial growth, but sustained significant popularity and continuous inflows from a really wide array of investors, institutional, wealth managers, even some retail. It's a testament to both the huge pent-up demand for a regulated Bitcoin product and let's be honest, the sheer power of BlackRock's distribution network and brand recognition.
That kind of growth in such a short period is truly staggering, especially for, a new asset class packaged in a regulated product. Why do you think BlackRock's fund, specifically IBIT, has attracted such significant institutional interest? Perhaps even more than some of the other approved ETFs. Is it just because they're BlackRock, or is there more to it?
Well, while it wasn't the absolute very first to market, you had Grayscale converting its existing massive Bitcoin trust, GBTC, on day one. BlackRock's reputation and sheer scale play an enormous, arguably decisive role.
And trust factor.
Absolutely. They are one of the largest, arguably the largest, and most trusted asset managers in the world.
Yeah.
They have deep, long-standing relationships across every segment of institutional finance, from university endowments like Harvard to pension funds, sovereign wealth funds, large family offices, global wealth managers, everyone.
They're plugged in everywhere.
Everywhere. Their brand lends immense credibility and trust to any product they launch. For an endowment like Harvard's, or any large fund with incredibly stringent due diligence processes, entrusting a portion of their capital to a firm with BlackRock's track record, their operational excellence in managing trillions across diverse, complex asset classes, that provides an unparalleled comfort level.
It removes a layer of risk perception.
Exactly. It's not just about the underlying asset or the ETF structure itself. It's about the issuer. It's about BlackRock's operational capabilities, their compliance infrastructure, their risk management frameworks, and their proven ability to handle trillions of dollars responsibly. This provides a critical layer of confidence for risk-averse fiduciaries making allocation decisions.
Okay, so Harvard's investment. Huge headline, obviously significant. But it isn't an isolated incident, as you mentioned earlier. It seems clearly part of a much larger, observable trend of widespread institutional adoption that's been quietly gaining momentum.
That's right.
Can you give us a sense of other prominent examples from our sources that highlight this broader institutional embrace? Who else is getting involved?
Absolutely. Harvard's move is maybe the most high-profile data point recently, but it's definitely part of a broader, more expansive tapestry of institutional capital flowing into these Bitcoin ETFs.
Yeah.
We've seen notable participation from really diverse institutional players.
Okay.
For instance, sovereign wealth funds. These are massive tools of national wealth, often derived from things like oil revenue. They manage money for entire countries.
Huge players.
Huge. Our sources indicate that an Abu Dhabi sovereign wealth fund's holdings in BlackRock's IBIT fund topped an astonishing $500 million at the end of the first quarter of 2025.
$500 million.
$500 million. From one sovereign fund into one Bitcoin ETF. This showcases immense international institutional interest, not just domestic U.S. interest. These are strategic pools of capital looking for diversified returns, maybe inflation hedges, perhaps even geopolitical diversification for their long-term reserves. Their investment signals a recognition of Bitcoin's growing role as a potential macro asset.
$500 million. That's a truly staggering commitment. And it's not just these international giants or university endowments, right? We're also seeing public pension systems dipping their toes in. These are often seen as even more conservative, given their mandates.
That's a critical point, yeah. Public pension funds are notoriously risk-averse. They have to be. They're focused on long-term stability, measured growth, ensuring they can meet their future liabilities to retirees, teachers, firefighters, state employees, etc.
Very conservative boards, typically.
Extremely. So the fact that the state of Michigan retirement system, for example, reported holding nearly $11 million worth of the ARK21 shares Bitcoin ETF, ticker ARKB, at the end of the second quarter, that is extremely significant.
Even though $11 million sounds smaller compared to Harvard or Abu Dhabi.
Exactly. It might seem small in absolute terms compared to those massive endowments or sovereign funds, but for a public pension fund, any allocation, even a relatively small starting one, to a novel asset class like Bitcoin is a landmark decision.
It shows they've crossed a threshold.
It indicates that after presumably rigorous due diligence, their investment committees, typically composed of very conservative financial professionals, actuaries, trustees, have deemed Bitcoin via an ETF suitable for inclusion, even just a tiny sliver, in their highly diversified portfolios. This suggests a growing acceptance of Bitcoin as a legitimate, if still emerging, asset class suitable for even the most stringent long-term fiduciary mandates. It truly signals a broadening of the acceptable investment universe for these cautious giants.
It seems like university endowments, in particular, might be somewhat paving the way here. perhaps being slightly earlier movers in this space compared to, say, public pensions. Harvard might be the biggest headline now, but they weren't necessarily the very first academic institution to get involved with these ETFs.
And that's a crucial observation. And it fits the historical pattern of the endowment model often being more innovative. While Harvard's investment is substantial and highly visible due to its sheer size and profile, other university endowments certainly preceded them. They were demonstrating a nascent but growing trend within academia.
With who?
Emory University, for instance, based in Atlanta. They became one of the first significant U.S. endowments to publicly report exposure to digital asset ETFs back in 2024.
Okay.
They acquired, I believe it was 2.7 million shares of the Grayscale Bitcoin Mini Trust, ticker BTC. At the time of their disclosure, that stake was valued at more than $15 million.
So another sizable bet from a major university.
Exactly. It highlights this growing, albeit still relatively nascent, trend among academic institutions. They're often driven by their longer-term investment horizons, which, frankly, allow them to stomach more short-term volatility in pursuit of potentially higher long-term returns. They have the luxury of time that many other types of funds simply don't.
And what's particularly interesting, digging into the sources, is that Harvard itself seems to have had a historical interest in crypto that predates these recent ETF approvals by quite a bit. This wasn't some snap decision apparently driven by the hype around the ETFs launching in early 24. It seems to be part of a much longer-term strategic consideration.
That's absolutely correct. And it really speaks to the methodical, long-game nature of these premier institutions. Our sources indicate that Harvard reportedly considered buying shares in crypto funds, maybe private funds or other vehicles, as early as 2018.
2018, wow, that's quite early in institutional terms.
It really is. So this isn't just a reaction to the 2024 EPF approvals. It suggests a long-term strategic interest, ongoing research, internal discussions happening over many years. It points to thorough due diligence and a patient, methodical approach to eventually entering this new asset class.
They were watching and waiting.
It shows they've been watching Bitcoin's evolution, analyzing its resilience across multiple, often brutal market cycles, and likely exploring the underlying technology and market structure for quite some time before making this substantial, very public move via the ETF. We've also seen other interesting activities in academia cited, like Austin University launching a dedicated $5 million Bitcoin fund with a unique 5-year HODL strategy.
A HODL strategy from a university.
Yeah, indicating diverse and thoughtful approaches to crypto investment within the academic endowment sphere. These aren't typically speculative gambles. They seem to be calculated long-term allocations based on research and conviction.
Okay, so that brings us to the big question. Why now? After potentially years of contemplation, why are these massive endowments, particularly Harvard with its $117 million bet, making the strategic play into Bitcoin through regulated ETFs at this specific moment? What's the underlying endowment management philosophy that allows for or even encourages such a move into what many still perceive as a pretty volatile asset?
Yeah, the timing is key. And it really boils down to the core mindset, the strategic framework of endowment managers, especially those at leading institutions like Harvard with their effectively perpetual time horizons.
Right.
Robert Kaplan, who's a distinguished Martin Marshall Professor of Management Practice and Business Administration at Harvard, he explained it perfectly in a 2017 video discussing the endowment itself. He said, and I'm paraphrasing slightly, the endowment and its asset allocation is set up to anticipate you're going to have some volatile periods.
Yeah, volatility is expected, even planned for.
Exactly. That philosophy is absolutely key. Endowments aren't managing funds for next quarter's earnings report. They are managing capital for generations, for the next 50, 100, maybe even 200 years or more.
It's a different mindset entirely.
Completely. Their investment horizon allows them, almost requires them, to withstand market fluctuations and try to capitalize on long-term secular trends, even if those trends involve assets with significant short-term volatility. They are fundamentally designed for patient capital and strategic long-term growth. And that often means investing early, relatively speaking, in innovative, potentially disruptive asset classes that might not yet be fully correlated with traditional markets.
So they're thinking decades out, not just fiscal years or even election cycles. That kind of profound long-term perspective naturally allows for strategic, calculated investments, even in assets that might appear pretty wild in the short term. It's about maximizing absolute returns over a very, very extended horizon. And that tolerance for short-term volatility in exchange for potential long-term outperformance. That's really a hallmark of the so-called endowment model of investing, pioneered by people like David Swensen at Yale.
Precisely. And this connects powerfully to the role of diversification, which is absolutely paramount when you're managing a multi-billion-dollar endowment across cycles.
Can't put all your eggs in one basket.
Not even close. Bitcoin, especially when accessed through a regulated liquid vehicle like an ETF, offers a potential new avenue for diversification. The argument, and there's growing data to support it, is that Bitcoin's price movements can be potentially uncorrelated, or at least less correlated, with traditional asset classes like stocks, bonds, and even real estate, particularly over longer timeframes and during periods of market stress.
So it could smooth out returns or boost them?
Yeah, potentially both. This ability to potentially enhance overall portfolio performance, particularly in the current economic climate, where traditional asset returns might be constrained by, say, low interest rates or historically high equity valuations, it makes Bitcoin an attractive proposition to investigate. Plus, endowments are always under pressure to seek strong, diversified returns to fund their institution's core missions, ongoing operations, cutting-edge research, financial aid, and scholarships.
They need the money to keep the lights on and fulfill their purpose.
Exactly. They're constantly scanning the horizon for assets that can potentially provide alpha, meaning excess returns above the market benchmark, often outside of traditional market beta. Bitcoin, for some, fits that bill.
And beyond the philosophical approach to endowment management and diversification, what about the maturation of Bitcoin and the broader crypto ecosystem itself? How much has that played into these decisions? Because let's be honest, a few years ago, the conversation around Bitcoin for serious institutional investors was very, very different.
Oh, that's a huge factor. Perhaps the biggest enabling factor, really. Bitcoin's perception has truly evolved dramatically in the eyes of many institutional decision-makers.
How so?
Well, it's transformed from being seen primarily as a niche, highly speculative digital curiosity, maybe associated mostly with retail investors or libertarian early adopters,
Right.
to becoming viewed as a more established, increasingly institutional-grade asset. The SEC approval of the spot ETFs was, as we discussed, a massive catalyst in this maturation process. It provided the regulatory clarity, the perceived market integrity via surveillance sharing, and the crucial operational accessibility that institutional investors like Harvard absolutely require.
But it's not just the ETFs, right?
Not at all. That was maybe the capstone. But leading up to that, we've seen significant developments in the underlying infrastructure over several years. Think about institutional-grade custody solutions provided by trusted regulated entities like Fidelity Digital Assets, Coinbase Custody, BNY Mellon dipping its toes in.
Big names getting involved in holding the assets securely.
Exactly. We've seen increased market depth and liquidity on regulated crypto exchanges, although that's still evolving. There's a growing, more sophisticated derivatives market that allows for hedging and risk management. And the broader global regulatory landscape, while still definitely fragmented and uncertain in places, it is slowly, albeit unevenly, moving towards greater clarity and definition in major jurisdictions. So the whole ecosystem feels safer, more professional. It's certainly becoming more palatable for institutions. So this move by Harvard or others, it's likely not a rash decision fueled by FOMO. Their history of foresight, like reportedly considering crypto funds way back in 2018, it underscores that they're likely acting on very thorough research, robust internal risk assessments, and a deeply held long-term outlook. They've witnessed Bitcoin's resilience, its technological robustness despite constant attacks, its growth through multiple boom and bust cycles, and they've moved past maybe initial skepticism to see its potential as a distinct, non-sovereign store of value or unique asset class.
Okay, so it's not just about the asset itself, but the entire ecosystem around it becoming more robust, more professional, and ultimately more acceptable, more palatable for traditional institutional players with fiduciary duties.
Precisely.
This brings us to what I was thinking of as the Ivy League effect. What message does Harvard's significant investment send to all the other university endowments, the pension funds, the sovereign wealth funds, family offices, and other institutional investors globally who might be watching?
The Ivy League effect is indeed a powerful concept here, and I think it extends far beyond simple validation. It's about de-risking the decision for others.
How so?
When an institution of Harvard's caliber, with its immense global reputation for rigorous due diligence, intellectual firepower, and generally conservative long-term strategy, makes such a significant public move, it acts as a critical de-risking signal for literally hundreds, if not thousands, of other funds around the world. Think about the internal conversations happening right now within other endowments, pension funds, foundation boards, investment committees, fund managers, or analysts who've been researching Bitcoin, maybe advocating for allocations, perhaps facing skepticism. They can now go to their boards and committees and say, look, if Harvard has done the immense work, if they've gone through their famously thorough risk assessments, if they satisfy their own stringent fiduciary requirements, and they've decided to allocate significant capital to this asset, well, that significantly strengthens our case. It provides an undeniable precedent from a highly respected peer.
It gives them air cover, essentially.
It provides professional cover, absolutely.
Okay.
It eases the internal governance burden, the career risk maybe, for those decision makers who might have been hesitant to be the first mover or an early adopter in their own peer group. It can potentially create a powerful domino effect, where those who are on the fence, perhaps waiting for a leading institution to make the first significant leap, now feel much more comfortable moving forward with their own allocations, knowing that a peer as respected and conservative as Harvard has, in effect, blazed the trail. It signals very clearly this is no longer just a fringe investment. It's becoming a strategically considered portfolio component for sophisticated capital.
Which brings us neatly to the broader implications and what this all truly means for the future outlook of finance. What's the profound impact, do you think, of Harvard's investment on the overall legitimization and integration of Bitcoin into traditional finance? Is this a tipping point?
I think it represents a profound, perhaps almost irreversible step in the legitimization journey of Bitcoin and, by extension, the broader cryptocurrency market within the established realm of traditional finance.
Irreversible, you think?
Well, maybe not irreversible in the absolute sense, markets ebb and flow, but in terms of perception and acceptance. This action pushes Bitcoin much closer to being considered a standard, or at least a candidate, asset class right alongside stocks, bonds, real estate, commodities, private equity. Rather than being permanently siloed as just an alternative, a purely speculative play, or a niche digital curiosity only for techies.
It gets a seat at the grown-ups table.
It gets serious consideration at the grown-ups table. Exactly. This is a crucial step towards its potential full integration into standard portfolio construction. It shows that the largest, most established, and often most conservative players are not just acknowledging its existence anymore, but are actively participating in its market, allocating significant capital. This, in turn, can reshape how regulators view Bitcoin globally over time, how other financial products get developed around it, how it's discussed in mainstream economic forums and by financial advisors. It becomes a topic for serious asset allocators, not just crypto podcasts.
Right. And if this trend, this Ivy League effect, and the subsequent validation it provides really accelerates, what are the potential ripple effects? What scale of capital inflows could we realistically see? Could more major endowments, pension funds, even more sovereign wealth funds follow Harvard's lead? And what would that actually mean for the crypto market itself?
It's not just a possibility. Based on historical parallels, when new asset classes gain acceptance, it seems like a high probability that we'll see a continued, perhaps accelerating flow of significant institutional capital into Bitcoin ETFs and indirectly into the underlying crypto market as this trend gains momentum.
What kind of scale are we talking?
Think about the sheer scale.
Yeah.
Institutional funds globally, pensions, endowments, sovereigns, insurance companies, corporate treasuries, they collectively manage trillions upon trillions of dollars.
Mind-boggling numbers.
Truly. Even a very small percentage allocation from just a fraction of these players, say 0.5% or 1% of assets under management, which is often a typical starting allocation for a new asset class, would represent hundreds of billions, potentially trillions of dollars in new capital entering the Bitcoin space over time.
Wow. Okay, that's potentially transformative.
It's potentially transformative. Now, that influx wouldn't happen overnight, obviously, but over the medium to long term, this kind of inflow could certainly impact Bitcoin's market structure. It could potentially lead to reduced volatility as more sophisticated, long-term sticky capital enters and counterbalances more speculative, short-term trading.
More stability.
Potentially, yes, over time. It could also significantly deepen market liquidity, making it easier to trade large sizes without impacting the price dramatically. And, of course, it would likely impact its overall price trajectory in the long term, potentially moving it further away from being purely driven by speculative retail sentiment or macro flows towards reflecting more fundamental demand from long-term holders and strategic allocators. It's effectively a potential re-rating of the asset on a global institutional scale.
It really does feel like it marks a significant, maybe almost irreversible shift in the narrative around Bitcoin, doesn't it? It's
Mhm.
moving beyond being just for individual retail speculators or the early crypto adopters. It's becoming a strategic allocation for some of the world's most sophisticated long-term institutional investors.
Precisely. And that narrative shift is crucial. It
Wow.
fundamentally redefines Bitcoin's potential role in the global financial ecosystem.
Yeah.
It transitions from being perceived perhaps as an edge case, an alternative investment, maybe even a digital collectible for some, to being seen as a legitimate component of a diversified portfolio, especially for those entities with very long investment horizons and mandates to preserve and grow capital across generations, potentially hedging against inflation or monetary debasement risks. This shift in narrative is perhaps one of the most significant long-term implications of moves like Harvard's.
So it's about a fundamental reevaluation.
It's about a fundamental reevaluation of what constitutes a valuable, resilient, and potentially growth-oriented asset in the 21st century digital age. It opens up Bitcoin as a new asset class for formal discussion and serious consideration in practically every institutional investment committee boardroom around the world.
So as we always aim to do on the deep dive, let's try to bring it back to you, our listener. What does this institutional embrace of Bitcoin, spearheaded by names like Harvard, actually mean for the broader economy, or perhaps just for your own understanding of investing in financial markets? How should people think about this?
Well, I think this trend signals a continuous, dynamic evolution of traditional financial systems. It really highlights that even the most established, most historically conservative institutions are not static. They are adapting, albeit sometimes slowly, to new technologies and emerging asset classes.
Finance isn't standing still.
It never does.
Yeah.
For you, the listener, it might mean reconsidering how you view traditional asset allocation models. Are they adapting quickly enough? It might simply mean observing how innovation in finance continues to reshape our world, creating new opportunities and new risks. It definitely encourages critical thinking about diversification strategies, of the nature of value in an increasingly digital age, and about what truly constitutes a valuable long-term asset in an interconnected, digitally driven global economy. It's a powerful reminder, I think, that even the oldest, most venerable institutions are looking towards the future, trying to position themselves for it. And that the financial landscape that you operate in, whether as an investor or just an observer, is constantly being reshaped by these very powerful underlying forces.
It's a profound thought, isn't it? As we wrap up this deep dive, the core insight seems undeniably clear. Harvard's substantial, publicly disclosed investment in a Bitcoin ETF is far, far more than just another financial transaction.
Much more.
It is a powerful, undeniable signal of mainstream institutional acceptance, or at least serious consideration, of digital assets.
Absolutely. This deep dive has clearly shown how large endowments, with their unique generational investment strategies, their meticulous due diligence processes, and their massive pools of patient capital, how they're increasingly finding a legitimate and strategic place for Bitcoin within their highly diversified portfolios.
Right.
It's a testament not just to the perceived maturation of Bitcoin as an asset class, but also, importantly, to the evolution of financial thinking and risk assessment at the very highest echelons of global finance.
And that leads us perfectly to a final thought-provoking question to leave you with, something to maybe mull over long after this deep dive concludes. If institutions managing tens of billions of dollars, institutions with a documented history of anticipating profound market shifts and meticulously preparing for volatility across generations, if they are now actively allocating significant capital to Bitcoin, what does that fundamentally tell us about the future direction of global finance? And what does it suggest about the potential enduring, perhaps even foundational role of decentralized digital assets within that future?
It's a huge question, and it's one that really invites further exploration, ongoing observation, and definitely critical thinking from everyone interested in finance and technology. This is truly just the beginning, I suspect, of a fascinating and potentially transformative intersection between the old guards of traditional finance and the rapidly evolving digital asset landscape.
So keep watching this space.
Definitely keep watching these trends because one way or another, they're actively shaping the financial future for all of us.